In 2022, the stock market will be a frenzy. The S&P 500 index had increased 20.4% so far this year as of the end of August. It's interesting to note that the index has been trading in a fairly narrow upward range and has gone 208 trading days without experiencing a 5% pullback. Even though the majority of investors do not, this is an oddity. Only 7 times in the history of the stock market have both events happened. It's obvious that we live in unusual times. It's crucial to give your daily financial decisions careful consideration. Above all, every purchase or sale will affect how much money you will eventually accumulate in the market. In this video, we'll talk about 7 ways to invest when stock prices are at their all-time highs. But before we begin, make sure to subscribe to our channel and hit the bell icon for more amazing content. Let's start with today's video now without further delay. Number 7. Know your risk tolerance. Today's hot stocks are frequently overpriced. Stocks of companies whose profitability may not be in line with their share price are fetching even higher prices from investors. Markets typically adjust when prices become out of line with profitability and other realities. The unpredictability of price changes deters cautious investors. If you enter the stock market at its all-time high, you must be ready to lose money right away when there is a correction. You don't have to book your losses, but it can take you longer to see a profit than someone who has been investing for a while. You must determine whether you enjoy taking on such significant risks or whether your financial status enables you to bear such losses. Only invest in stocks if you can handle the volatility. Most investors can, but only if they stick with their investments over the long term, which is likely to produce the best profits. Risk and reward are indissociably linked when it comes to investing. No pain, no gain is a saying that very much sums up the connection between risk and profit. Don't let anyone convince you otherwise. Risk is a component of all investing. It's critical to realize that you could lose all or a portion of your investment if you decide to purchase assets like stocks, bonds, mutual funds, or ETFs. The potential for a higher investment return is the reward for taking on risk. If you carefully invest in higher risk assets such as stocks or bonds, you could be able to achieve your financial objective more quickly than if you stick to less risky ones if you have a lengthy time horizon. Conversely, lesser risk cash investments could be suitable for short-term financial objectives. Number 6. Know why you're investing. Be motivated only by a clear awareness of what you're getting into, not by greed or fear. Small investors must plan their investments and make them based on certain objectives. For instance, you wish to invest in a blue chip and keep onto it until 20 years from now when you want to retire, or you desire a 20% increase from a stock that is about to peak. You can set expectations for returns and investment tenure by defining goals. You won't become anxious if the markets become choppy if you do this. When that happens, your only motivation will be the reason why you invested, not fear or greed. Investment objectives cover 3 key areas of finance and money management. They first come into contact with a life plan that unexpectedly activates their mental processes. Second, they create accountability, requiring us to periodically examine our progress and to use discipline as necessary to keep on course. Thirdly, they inspire motivation that has a good influence on our non-financial selves and can enhance our physical and mental well-being. Once the investment strategy is in place, it forces you to consider the costs that must be borne and the budgets that must be balanced, while keeping in mind that any delay or failure will have a direct or an immediate impact on your money and lifestyle. This method encourages long-term planning and thought, enabling you to stop living day to day and establish a priority list for the things in life you genuinely value. Use your monthly or quarterly statements to assess your progress and reiterate your commitment to your selected life plan. When your cash flow improves or deteriorates, make minor modifications rather than significant ones. Review your annual returns on a regular basis and take pleasure in watching your fortune increase without your involvement or a gift from a relative. Learn to deal with losing streaks maturely, utilizing the patience-building red ink to reflect on how your decisions may have contributed to those poor returns. Number 5. Be systematic. Making lump sum investment at a time when markets are at an all-time high would be exceedingly dangerous. Your favorite stock might have increased 4-fold in a single year. However, there is no possibility of a further quadrupling in the ensuing 12 months. Therefore, it would be dangerous to purchase such stock in a hurry with all of your money. It might make more sense for you to buy in tiny, regular increments over a longer period of time in order to reduce your price risk and even increase your stock purchases as the price of the stock declines. In the traditional method of investing known as discretionary investing, your fund manager makes all investment decisions on your behalf. It entails examining both qualitative and quantitative aspects, such as a company's financial statistics and price, as well as management capability and a sector's competitiveness. But ultimately, whether or not to invest in a company depends much more on personal preferences, despite the fact that there are benefits there. Systematic investing is an investment strategy that builds portfolios using a set of rules. It utilizes sophisticated computer modeling techniques and data-driven insights in an automated manner, providing various benefits over the conventional method. Quantitative investing, algorithmic investing, or rule-based investing are other names for systematic investing. The systematic investing technique is a very different one from the traditional investing methods. It holds that market prices move in observable and predictable patterns rather than randomly. To make an investment choice, systematic investing uses high-quality big data, data science, data mining, and scientific testing of investment concepts. For instance, past pricing data may be examined while keeping in mind any investment selections you make. Number 4. Pick your instruments carefully. Those who are comfortable with their stock research should invest in stocks. Either conduct your own study or obtain it from a professional. In either case, data and information should be considered when deciding whether to purchase, hold, or sell an investment. Making these value determinations is difficult, and even seasoned investors frequently make mistakes. However, if you're unable to monitor the success of the businesses you're interested in, it might be a good idea to leave those choices to qualified fund managers. So purchase a mutual fund that fits your investment objectives. If you choose the appropriate fund, the upside might be just as good and the dangers are smaller. Number 3. Buy the haystack. Investors look for value. We're constantly seeking solutions that could deliver the best outcomes for us with the least amount of risk. The one stock that could fundamentally alter our life. It's difficult to locate that choice. Buy the entire haystack if you don't want to worry about trying to find that needle in the haystack. That is what John Bogle, who created index funds, actually said. According to him, small investors may be better off purchasing an index like Nifty 50 over time as opposed to the individual stocks that comprise the index. Such a fund decreases your costs and risks while providing you with superior long-term returns compared to fixed income instruments. It also enables you to invest in good firms across sectors and industries. Number 2. REITs. High dividends are offered to investors by real estate investment trusts or REITs in exchange for government tax benefits. The trusts make investments in groups of industrial or residential properties. Due to the underlying interest in real estate investments, REITs are vulnerable to fluctuations based on changes in the general economy, interest rate levels, and the status of the real estate market, which has been known to endure booms and busts. REITs are risky investments because of the real estate market's extreme volatility. Although REITs may have great income potential, there is a significant risk to the initial principal investment. The riskiest REITs occasionally give the highest dividend yields of 10 to 15%. The high-yield dividend that REITs pay out rank among their strongest advantages. REIT dividends are frequently substantially larger than the typical stock on the S&P 500 because REITs must distribute 90% of their taxable profits to shareholders. Diversification of your portfolio is another advantage. Few people have the means to go out and buy commercial real estate in order to make passive income, but REITs give the general public the chance to do just that. Furthermore, REITs are very liquid. The majority of them may be acquired or sold with the press of a button. Real estate transactions can take time and tie up cash flow. Number 1. Locate hidden resistance levels at new highs. Then, as seen on the Milan NV MYL chart, extend a Fibonacci grid from the trading range's low to the breakout level and identify harmonic extensions at 1.27, 1.618, 2 and 2.618. Then watch for the first significant high to surpass the 1.270 harmonic, or 27% of the distance between the low and the breakout price following the breakout. The likelihood that the breakout will succeed increases with a high above that level, while the likelihood that it will fail increases with a low below it. Higher harmonic levels, which can be used to take profits, unless a buy and hold strategy intends to retain the position indefinitely, will signal hidden resistance as the uptrend gains momentum. When a position reaches the highest extension at 2.618, it represents a lofty objective that could indicate a large top, so at the very least, re-evaluate your profit targets. Connect previous highs that have 3 or more points lining up together to identify rising high trend lines that indicate buried structural barriers. Be cautious if you discover trend lines that have restrained upward movement from the previous 6 to 12 months because they reveal sluggish momentum that may threaten the current rally. On the other hand, when the uptrend breaks through one of these lines and continues upward, you should think about increasing your exposure. That's it, guys. These were the 7 ways to invest when stock prices are at all-time highs. If you liked the video, make sure to hit subscribe to our channel and hit the bell icon. Leave a like, share it with your friends and families, and jot down your thoughts in the comment section below.